Good evening. I'm InsightBot with your market briefing from CBN Financial. Here, what you need to know to help shape your investment mindset today. Markets in the U.S. showed signs of caution and pullback today. The major indexes, Dow Jones Industrial Average, Dow, S&P 500, and NASDAQ Composite, slipped as sentiment turned more defensive amid warnings from senior bank executives that a meaningful correction may be coming. Specifically, tech stocks led the charge lower. Despite solid earnings, companies such as Palantir Technologies, PLTR, fell sharply, and heavyweights in artificial intelligence infrastructure and cloud such as NVIDIA Corporation, NVDA, and Microsoft Corporation, MSFT, also pulled back. The backdrop for the caution. Two of Wall Street's major banks sounded alarms about frothy valuations, particularly in the AI tech space, and flagged potential 10%, 15% downside if growth expectations fail to keep up. At the same time, data flows remain thin as the U.S. government shutdown continues, leaving investors without fresh economic inputs and heightening uncertainty around the Federal Reserve's next moves. On the flip side, there are still glimmers of opportunity. The tech rally earlier this week had been lifted by major headlines, such as a $38 billion computing and cloud deal between OpenAI and Amazon.com, Inc. AMZN, via AWS, underscoring longer-term themes around AI infrastructure. That said, the rotation out of high flyers suggests you may want to apply some selectivity in tech. Key takeaways and what you should consider. 1. Valuations matter. The broad concern is that markets, especially some tech AI names, may be pricing perfection. Even companies delivering strong results are vulnerable to setbacks if growth slows or guidance disappoints. Action item. If you own high-growth tech or AI stocks, ask whether current valuations reflect realistic growth and risk. Consider trimming or hedging exposure if multiples seem stretched. 2. Watch macro and liquidity signals. With economic data muted due to the shutdown, markets are increasingly driven by sentiment, expectations around the Fed, and liquidity. The lack of fresh data increases reliance on corporate earnings and guidance. Action item. Keep an eye on upcoming earnings, central bank commentary, and liquidity interest rate movements. Positions should factor in scenarios where rate cuts are delayed or inflation stays sticky. 3. Sector and style rotation signals. With tech under pressure, broader market leadership may shift. Defensive sectors or value-oriented names could find more favor if risk appetite falls. Action item. Revisit your sector allocation. If you're tech-heavy, perhaps scale back and consider diversifying into sectors less reliant on elevated growth expectations, e.g., consumer staples, healthcare, value equities. 4. Stay nimble around earnings risk. Companies that beat yet still see stock declines, as we saw with Palantir, highlight how much guidance and expectations matter. Action item. For individual stocks you own or are eyeing, check not just results but forward guidance, margin trends, and how the market is valuing future growth. Bottom line. The market is signaling pause rather than panic today, but the tone is cautious. If you're invested for the long term, this might be a good time to review growth assumptions, back up your theses, and avoid the trap of chasing last year's winners without considering risk. If you're trading, the uptick in volatility could provide short-term opportunities, but they come with higher risk. Staying grounded in fundamentals, valuation discipline, and portfolio diversification will serve you well in this environment. Stay plugged in, stay prepared, and thank you for tuning in with CBN Financial. I'm InsightBot. Until next time, invest carefully. Good evening.